The churn in the financial markets continues. There does seem to be a little bit of an unclenching in risk sentiment. Bonds up, stocks up, the US dollar idling. That follows some perhaps, maybe, possibly moderating rhetoric out of the White House, but the upshot of the situation broadly unchanged, and the key markets still at key decision points from the beginning of this month, and we'll have to figure out what the price action is going to tell us about that. So in the meantime, we are going to take a look at a broader view of what may be going on here, and get back to our conversation about the diminishing confidence in the US dollar, or so it would seem. We talked about why the current environment has been so negative for the US dollar, as we've seen a kind of sell everything US related kind of a dynamic since the beginning of this month. We've obviously seen stocks go down in the US, bonds go down in the US, and the dollar go down all at the same time in what has been a little bit of a change of pace, the dollar seemingly losing its capacity to rally as a haven on risk-off momentum or on higher yields. Those yields, of course, going up for the wrong reasons, but nevertheless. And so it bears asking, well, if not the dollar, then where? And if the currency world is not through its readjustment on the dollar, then where is there more room for this to continue? So we'll start this conversation here with a relationship that really illustrates why the dollar probably has more room to go down, even as we consider a kind of maybe preliminary unclenching of the issues that we've seen sort of hit the headlines and break out into markets. So this is a chart from the American Enterprise Institute, and it nicely distills what is the relationship between the U.S. trade deficit, ostensibly the thing we're trying to defeat with these tariffs, and its actual implications for what happens with the U.S. economy, and consider that actually what this is effectively a benefit and not a cost. And so consider here that what happens when this trade deficit is incurred, and that's the light blue line here, what is essentially occurring here is an outflow of dollars into the hands of foreigners. And that sounds bad, but consider actually what we're saying. Foreigners end up with a bunch of dollars having sold Americans primarily goods. That's generally where most American imports are. We take care of our services demand via domestic firms for the most part. So, and we're net exporters of services, actually. So on the goods side, we're, of course, net importers by a long mile. And what that does, because clearly nobody's getting on a plane to buy their made in China or made in wherever stuff, they're buying it at their local store here in the U.S. So foreigners, and of course they end up paying for it in dollars. So we're simplifying supply chains for the benefit of the conversation, but the upshot here is foreigners then end up with a giant pile of dollars. And the question then becomes, well, do you convert those dollars back into local currency and invest in your own economy, or do you keep it in dollars? And what has been happening, basically going all the way back to the dawn of this system, which follows the untethering of the dollar from gold in the early to mid 70s, is this idea and this understanding on the part of our trading partners that if they were to convert that pile of dollars in size back into their local currency and repatriate that money, what would happen is the dollar would, of course, fall, because that would amount to selling dollars. Well, and then the purchasing power of their consumers in the U.S. would go with the dollar, and they wouldn't be able to buy all those exports anymore, not nearly in the same size or volume. And so what has happened is a recycling of dollars back into U.S. financial assets. That, of course, is a huge benefit for the U.S. because, number one, it is a huge inflow of capital into U.S. equity markets, which helps finance U.S. corporates. Number two, it is a huge inflow into U.S. Treasury securities, which helps keep interest rates low for the government and for all of the consumer lending rates and business lending rates that use treasuries and treasury yields as benchmark, which, surprise, surprise, is nearly all of them. So what you're looking at then is the upshot of the current account deficit being cheaper U.S. borrowing costs, higher U.S. stock markets, better capitalized U.S. corporates. And of course, since most pension money is basically just market tracking the S&P 500, that's a benefit for everybody involved, even for, let's say, public sector pension holders. Indeed, the largest holder of U.S. equities is CalPERS, the California fund that manages the money of public sector pensioners. So you have a situation here where the halving of the trade deficit, that is more open commerce, and the thing that we're attempting ostensibly to fix, as a mechanism for putting dollars in the hands of foreigners that they then reinvest in the U.S., that, of course, makes the U.S. dollar stronger. Now, lest you say, well, this is only through 2015, a decade has elapsed since, surely this situation has changed. Well, not so much. Here is a view that updates at least the trajectory, and of course these are different magnitude things because we're not dumping all of the sums that are embedded here into this. We're just looking at the direction of travel for the theme. You can see here U.S. foreign direct investment since the end of the pandemic has surged, which of course has been finding a mirror image in a widening U.S. current account deficit. Not surprisingly, of course, the U.S. economy has been the one that has grown most robustly of the majors. We've seen that time and time again, and you can see that again more recently. More foreign direct investment, even just in the past several years, and a steeper trade deficit. You might take issue and say, well, look, these magnitudes are different. This is some sort of chart art situation. Does this really hold? Well, again, these are not full aggregates. They're meant to show not the perfect relationship, but the trajectory of the theme. But let's take a look at the latest numbers from the U.S. Treasury Department and take a look at the sheer size of foreign holdings of U.S. securities, be it short-term debt or long-term debt or equities. And consider that this is in the trillions of dollars. So we're looking at somewhere in the neighborhood of approaching $30 trillion. Let's be generous and say it's somewhere between 25 and 28, something like this. And you can see that these numbers have steadily grown, and indeed, since the pandemic, they have actually become more dramatic, which of course is exactly what we find right here. So the essence of the relationship very much holds. And so it should not be any kind of a surprise that since the beginning of the year, as we were about to get an administration that very clearly presented itself as minded to close the trade deficit and to become generally more protectionist, that what you would see is a situation where the US dollar would weaken, because if you reduce volumes of trade, be it with tariffs, be it some other way, of course, in this case it is tariffs, if you reduce the volume of trade, then you reduce the amount of dollars that foreigners hold. And then this dynamic starts to cave in on itself. If they have fewer dollars, then they have fewer dollars to reinvest. If you give them a reason to be concerned about reinvesting those dollars, then maybe they will be more inclined, especially if they anticipate that volumes of trade downwind are going to be reduced and there's less of a reason to want to keep the dollar uplifted for purchasing power of your exports, because what the U.S. has done is basically blocked those exports before that's even a consideration. Well, then you might have an exodus out of the U.S. dollar. And indeed, as we see here, this is a chart of the U.S. dollar index, which is an average of the U.S. dollar's value against its major counterparts. And needless to say, I've decried the limitations of this thing because it was constructed before there was a euro. And so all of the legacy currencies that used to make this a diversified basket are now essentially the euro, and this might as well be then the euro-US dollar exchange rate upside down. The basket doesn't include a China proxy like the Australian dollar, which at this point is the fourth most actively traded currency, according to the most recent data from the Bank of International Settlements, which we'll take a look at in just a second. But nevertheless, the thematic implications of what's going on here, those hold. The upshot of saying to the markets that we are going to try to close the U.S. trade deficit, and the way that we're going to do it is we're going to erect trade barriers that make it less attractive to buy from abroad. That's going to weaken the dollar. And the reason it's going to weaken the dollar is because this recycling of dollars from the trade deficit back into the U.S., that sort of process will be fundamentally undermined by trying to close the avenue by which foreigners end up with those dollars in the first place. And then, of course, comes the question, well, okay, so what then is the next step, and which currencies might you then expect to benefit? Because, again, that money has to go somewhere. Things are still going to be sold, but maybe there's not a reason to dump them back into U.S. markets, and maybe the volumes are less U.S. versus rest of world, but rest of world still has its wares to sell. And so capital is going to go, it's just not going to go into the U.S. So then which currencies ought to be the beneficiaries if the dollar is going to lose some of its quote-unquote market share? And as promised, here are the latest numbers from the Bank of International Settlements. They are as of 2022. That's the last update. They're on a triannual schedule, so we should get another update of these numbers this year. But as it stands, this is where we are, and these things are not terribly volatile, so this is still quite an accurate reflection of current reality. You can see that the next most liquid currencies after the dollar are the euro and the yen. And of course, we can see the drop-off is absolutely staggering. And lest you think that the BRICS, which I've made into a grouping here, lest you think they're in contention, just consider how absolutely minute they are relative to the amount of monetary transactions settled in the dollars, and also consider that they are just a touch above only China by itself. So really, this BRICS number minus China is barely a rounding error and barely even visible on this chart. I mean, here's Brazil, here's Russia, India is over here, and China's right there. So we're talking about barely visible amounts of volume. And this is not really a contender. There is no way that you could shove anything like a meaningful amount of US dollar market share in terms of settlement payments into this. Now, when you combine the euro and the yen, you're looking at about 3.5 trillion. That's to the US dollars 6.6. So it's about half. So you might see, let's say, this big share of the dollar diminished down, let's suppose, halfway. Maybe, I mean, that would be catastrophic, of course, but let's say you could have room to reduce this by some measure, where the US would be still overwhelmingly the dominant, because there's nothing even remotely close in terms of market size and liquidity and stock of assets to absorb all of this kind of liquidity. But you might perhaps see the tally here come down a bit and the tally here come up a bit. And of course, the problem with expecting the China tally to come up a bit is they don't have markets that are entirely open or even close to open. There are significant capital controls. Liquidity is non-existent in sort of any kind of practical sense, and it'll take a really long time to start to rival the U.S. in terms of financial heft, even though the economy is the world's second largest, just because of the way that capital is gated onshore. And so you're looking at the liquid alternatives where capital can move freely. And needless to say, the natural kind of alternatives that stand out are the euro and the yen. And with that in mind, it seems hardly surprising that those have been the two currencies that have outperformed against the dollar since the beginning of the year. These are percent change numbers for the benchmark futures for the top four currencies most transacted against the dollar. And you can see here it's euro, yen, pound. China's capital controls take it out of rotation. The next one is the Aussie. And those are the four that you see here. We can see the Aussie has lagged. The pound has lagged. The euro and yen have added north of 10% apiece. You might say, well, why are we talking about this now? There's already been a massive rally in these currencies against the dollar, and if anything, they're starting to pull back a bit. We were looking at gains of as much as 12% only a few days ago. Isn't this move over? Well, in my mind, that's the perfect time to be talking about this, because if there is some sort of a near-term correction in this, then what it offers is an excellent buying opportunity. And the time to think about it isn't when that buying opportunity has already appeared. It's when you anticipate and you can prepare for it to actually show up and have the capital and the key levels in mind to actually make that into an actionable thesis. Because indeed, this is not the kind of thing where the dollar sells off because maybe President Trump is going to attempt an extrajudicial firing of Chair Powell. This is not the kind of thing where you get an episodic response to maybe a trade deal with China, maybe not, depends on who you ask. If you ask Treasury Secretary Scott Bessent, the deal is inevitable. If you ask Chinese officials that commented overnight, nobody's talking to them and there is no substantive discussion and they have no idea what the White House is talking about. Obviously, we take both things with a grain of salt. It's a negotiation between rivals. They're attempting to paint the tape their way. So as we look at all of this, the upshot is, beyond these headlines, is there a structural direction? And I think clearly, as we see from the trajectory of the dollar going all the way to the beginning of the year, there indeed is. And we've gone up and down along the way here, but the trend is the trend. And what it reflects is this structural unwinding of these dynamics. And so, while the dollar may be done falling here in the near term, the trend remains and the structural underpinnings for it continue. In the most sort of hands-on practical sense, we still are looking at sizable interest rate cuts for the U.S. this year and next, looking at about 110 basis points at this point. Cumulatively, not surprisingly, that tally has increased significantly since all of this concern around the tariff rollout has hit fever pitch late February, let's say, up through now. The expectations have become increasingly more dovish. But against that backdrop, the situation in Europe is quite different. First off, we're looking at less of a tally, so less by about a rate cut than what we have for the U.S. But more importantly, theme-wise, we are starting to see over the recent months, really since the beginning of the year, the idea percolate that maybe next year is a year for rate hikes out of the Eurozone, which would only make the U.S. dollar weakness argument stronger. Because, of course, then yield differentials in a very classic way would shift against the dollar. And this idea that maybe we're looking at rate hikes next year, this follows Europe's seeming conclusion that the U.S. security blanket is now unreliable and that NATO ex-U.S. needs to arm itself. And so there's been a dramatic push, especially in the Eurozone, to spend a bunch of money to rearm. That, of course, is going to be a boost to both growth and inflation, and the ECB is going to have to approach it as such. And so we've seen a sense show up here that the sort of rate differential that maybe favored the U.S. dollar this year, however ineffectively, will actually invert on it next year. That, of course, is something markets might front run as the dust settles. And, of course, for the Bank of Japan, the story uniquely amongst the major economies has been of rate hikes. We can see on the bottom here the spread between the current implied futures curve, that's in the red here. It was a little bit more hawkish a month ago, but nevertheless, it still points to hikes. We can see the difference going into the back half of this year between the current target rate and what the curve implies is positive. That is to say, we are looking at rate hikes into the back half of this year from the Bank of Japan, and that really should be something that makes quite a bit of sense if you consider that we just got PMI numbers this week out of Japan that, unlike many of the other major economies, were blisteringly strong. And so the argument here still seems to favor a U.S. dollar that weakens as U.S. trade policy gets more protectionist, and the euro and yen as the likely winners from that for months and quarters to come, if not perhaps just right here. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be back with Chris for Futures Power Hour tomorrow, back with Victor and Tom for First Call on Sunday, writing for the News and Insights portion of tastylive.com, opining at Ilya Spivak on the platform formerly known as Twitter, and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.